Ever wonder why scam calls feel so specific? Why they somehow already know your name, your city, or even your address? It's usually because of data brokers. These companies collect your personal information from across the internet and sell it online, usually without you even realizing it. Things like your phone number, home address, family members, and even places you've lived. And once your information is out there, it spreads fast. That's where Aura comes in. Aura automatically finds your personal information on data broker sites and submits removal requests for you. Then Aura keeps monitoring to help make sure your information stays gone. You can even see where your data was found and removed. And Aura goes beyond data removal. You also get a VPN, antivirus, password manager, spam call protection, dark web monitoring, and up to $5 million in identity theft insurance. Right now, you can try Aura free at aura.com/hidden. That's aura.com/hidden.
This is Real Estate This Week with Stephen Gasque. 17 years on air and online, helping you succeed in buying, selling, and investing in property. The best real estate strategies out there, just for you.
Welcome to Real Estate This Week. Hi again, I'm Stephen Gasque, and I'm delighted you're here for The Mortgage Show, all about getting the very best mortgage for you in any real estate market. We'll talk credit, income, and savings, and how each one affects the mortgage payment you'll make every month. So let's dive in and get the facts about mortgages. Joining us now is Keith Gumbinger, Vice President and Mortgage Expert at HSH.com, the nation's leading source for consumer mortgage and finance information. Keith, welcome to Real Estate This Week.
It's good to be here, Stephen.
I am so glad you're with us. And so, Keith, on today's show, I'd like to tell our listeners the most important things they could possibly know about getting a mortgage. Advice that would help them in today's market, in the market a year from now, or even in a market 5 years from now. So let's begin with the most important thing you would tell anyone who plans on getting a mortgage.
Well, it all depends on how well you fit or don't fit into the housing market in which you find yourself. I mean, overall, the best thing you can do is protect your credit rating. It's the key to almost everything. You'll also want to start the process of getting your credit in order sooner. Lenders now use trended credit reports to produce your score, and that looks at how you've managed your debts over the last couple of years. And I'd also like to note that, speaking of a couple of years, you'll also want to start saving as soon and as fast as you can. Having more cash to work with when you're going to get your mortgage and buy a house is going to open up options for you.
Okay. And Keith, let me ask you about a potential home buyer who's talking to a lender. Now, you've told me many times that one of the first steps is to talk not only to one lender, but to many lenders, 3, 4. And so tell us, why is that so important?
Well, I find it helpful for folks to think about mortgages as a product you buy. Now, there are lots of retailers and brokers selling essentially the same products, but they do so in different cost environments and sometimes from different suppliers or wholesalers. That means prices, rates, and fees can vary from place to place. And it's also true that not all lenders compete in the market in the same way. Some of the best-known names don't necessarily offer the lowest prices, but perhaps prefer to compete on service or technology offers. So you need to decide what you need and you want, then compare offers from a range of outlets in order to get the best deal.
Okay. And Keith, if a mortgage lender sat down with someone who wanted to buy a house and they needed a mortgage, what would be the typical qualities of someone who immediately got the loan, the best mortgage at the best rate and the largest amount possible?
Well, it's important to know that you don't have to be a perfect borrower to get a mortgage. But if you want the lowest rates, you want to qualify easily and have lenders beating a path to your application, you'll need to be a premium borrower. Now, that means a FICO score north of 780, a deep pool of assets on which to draw for a down payment and closing costs, little debt relative to your income, and an income that's well in excess of what you want to borrow when you're out shopping for your home.
Excellent. And Keith, now let's flip the scenario. If someone were applying for a mortgage and they were denied at lender after lender, Keith, what do you think would have caused a denial at multiple lenders?
Well, the good news is that lenders will tell you why your application is denied and try to give you some pointers or a sense of what you need to do to correct the stumbling block or blocks that are keeping you from getting a loan. Poor credit, I mean, literally a FICO below 620 in today's market, will be a primary reason you might be denied. And insufficient work history might likely be another. Lenders usually want to see about 2 years worth of stable employment before they'll make you a loan. Now, too high of a debt load to be able to comfortably afford the loan you're seeking might also be a setback, although you might qualify for a lesser loan amount.
I see. And Keith, that whole thing about the credit score is a real problem, because if you are denied because your credit score is 620 or lower, once you get that denial, it'll probably drop even lower than that.
Well, it's definitely not going to help the process, but will give you a starting point to go get that corrected so you're in a better place when you come back to the market again.
Excellent. And now, Keith, let's dive deep into the fundamentals, what they call the triple play of getting a mortgage, including your credit, your income, and the amount of cash you have available. Now, starting with credit, Keith, how good does my credit need to be to get the very best possible home loan rate?
Well, for the best of the best rates, you'll need best of the best credit, Stephen. And so a FICO score above 780 is what you should be shooting for. And of course, higher is better than that, although there's not a great amount of premium that is a much, much lower rate for having, say, a FICO 800. But 780 and above is where you're going to find the lowest possible rates.
Excellent. And Keith, what sort of score would get me sort of an, well, okay home loan rate?
Well, Equifax and Experian put the average credit rating in the U.S. at a little over 700 right now. While this is pretty good, the interest rate on your loan will be at about a quarter percentage point higher than someone with a 780 score. Or you'll pay about a 1-point fee in order to get the same rate as someone with that higher score.
Keith, a few minutes ago, you said that if you had a score of 620 or lower, good luck getting a mortgage. But would that mean that with 630 or 640, I might be able to qualify? And if so, what would happen to my rate then?
Well, anything above 620 and you will be eligible for a Fannie or Freddie backed mortgage. But of course, that low credit score, and especially if you start to couple it with a smaller down payment, is going to mean that your interest rate is going to go up. By the time you get down to a FICO 620, you're probably talking about an interest rate that's a 0.5 percentage point higher, maybe 0.75 percentage point higher than someone with that top flight credit score.
And that is a much higher monthly payment.
Or could limit the amount you could qualify to borrow.
Good point, Keith. Good point. And now let's move on to income. I know that when you apply for a mortgage, the income is kind of a sliding scale. No one specific amount of income is really required. But you've told me in the past that what is required is an income that matches the price of the house you want to buy. So, Keith, how do you figure that out?
Well, your income and your debt load will determine how much money you have available to spend on your mortgage. Qualification calculations are based upon your gross before tax income, and you'll usually be allowed to use about 28% of that figure for the principal, interest, taxes, and insurance portion of your monthly payment, also including any homeowner association fees that might apply in your circumstance. Now, while there's less of a hard cap than there used to be, you'll also generally be allowed to carry some debt on top of that, perhaps another 8% or so, but it can be more for folks with top flight credit or for those who have deeper reserves available.
And Keith, you make a really good point about the debt to income ratio. Because sure, if you have a great credit score and you have a ton of money in the bank and you have a great income, well, if you also have huge debts every month, even with the other three things being great, you might not get the mortgage.
Well, the more debt you have, the less you will have available to spend on your mortgage, principal, interest, tax, and insurance payments every month. So you can carry more debt, but that means you're going to be carrying or allowed to carry less mortgage. And if you want to go through those numbers and figure them out, we've got a How Much House I Can Afford calculator at hsh.com that'll help you figure out those numbers.
Oh, that's awesome. And so, Keith, when you talk to most people about buying a house, their first concern is having enough money for the down payment, the cash. So, Keith, how much money does a potential home buyer really need to have in the bank, ready to go, if they want to buy a house?
Well, believe it or not, Stephen, how much you need for a down payment will actually start with your income. If your income will qualify you for a $300,000 loan amount, for example, and if you need to borrow all of it to participate in your local housing market, you'll likely need a minimum of 3% more than that, about $9,000 in this case, just to qualify for certain Fannie Mae programs. Typically, you'll need about 5% more than that, so $15,000. And even for something like an FHA loan it'll carry a 3.5% down payment, so $10,500 if you're going to go the FHA route. Of course, for a conventional loan, more is always better, since that small down payment means a higher cost for private mortgage insurance. PMI costs factor into how much your principal, interest, and taxes and insurance calculation will be. So higher costs for insurances will lower the amount for which you qualify.
And Keith, when most people talk about buying a house, they really focus on coming up with the down payment. But there are other costs as well, like closing costs. Now, in some markets, sellers are being generous and helping with closing costs, but if they don't, you're going to have more than just the down payment.
Well, that's true, Stephen. You'll need money for closing costs. You'll need money for ancillaries. And of course, you'll also need more upfront cash to fund escrow accounts to cover insurance and taxes and such. Now, it's not uncommon for total out-of-pocket costs for a purchase, including your minimum down payment, to be 5 to 8% of the purchase price. But of course, it could be more.
I see. And Keith, as we mentioned a few minutes ago, that some sellers are being generous, and they will help a buyer with closing costs. If they do that, does that somehow mess up the mortgage for the buyer because they're getting money from another source?
Well, Fannie Mae calls these contributions, if you will, interested party contributions. And provided they are fully disclosed, they shouldn't negatively affect your mortgage transaction, although depending upon their amounts, they could potentially affect the final loan-to-value ratio calculation. Now, these funds can come from the seller or from a third party like a nonprofit agency. There are limits on how much an interested party can contribute. For example, Fannie Mae limits them to 3% for loans with loan-to-value ratios above 90%.
Now, Keith, say that you do apply for the mortgage and you are approved for it. You'll come away with a letter, either a pre-qualification, a pre-approval, or in some cases, a pre-underwriting letter. Can you tell us about those and what the difference is?
Well, pre-qualification is all about a working ballpark estimate of what mortgage your income will support. Now, often this calculation is done by realtors or sales associates so that they can help define the price range of properties you may be able to afford so that they can take you out into the marketplace. Now, pre-approval goes one step further. You'll actually place a mortgage application with a lender and provide necessary credit, income, and debt documentation. From these, and subject to verification and updating, a lender can issue you a conditional commitment so that you can know with great certainty that you qualify for the financing you need in order to make offers on available properties. Now, pre-underwriting goes far deeper into this process. The information you provided is sent to an underwriter for full verification. Essentially, your application and your submitted documents will be vetted, and once verified, you'll be in a clear-to-close situation for the mortgage type, term, and amount, pending only satisfactory appraisals, inspections, or other property-related items needed to close the loan.
And that is the most powerful kind of pre-approval mechanism that exists.
You'll be ready to go in at least as good a position as any borrower can possibly be.
But Keith, if you have either a pre-qualification or a pre-approval or a pre-underwritten commitment, you could just about light a match under any of those letters if you go out and buy a brand new car, or if you go out and buy a house full of furniture. If you mess with your finances between the time you get that pre-approval letter and the time you want to buy a house, you could blow the whole mortgage.
That's absolutely correct, Stephen. If you start talking about changing your credit profile or any of your other financials, that's a big no-no while your mortgage is in process. Now, you don't want to open any new accounts or take on any new debts while the mortgage is in process, even if you really want to get a head start on shopping for new furniture or fixtures or decide it's time to replace your car. Don't disturb your assets. Don't make big deposits. Don't make big withdrawals from your accounts. Don't change jobs or quit a job, although adding one is fine. Lenders don't want to see you upset your employment history while you're in the process of doing this, because now you don't have a full 2-year history of employment. You want to make sure that you also lock in the interest rate. Aside from you disturbing your credit profile, market conditions can disturb your opportunity to borrow the amount you need. So even a relatively small increase, like the half-point rise we saw in March and April of this year, could be enough to make your deal unaffordable. So locking in your interest rate can help protect you as well.
You make a really good point on all those subjects, Keith. But one that's really interesting is when you said you don't want sudden money coming into your account either. Now, people would probably think that, hey, if I have more money in the bank, it's going to be even better for my mortgage. But the lender's going to want to ask, where did you get that money?
Yes, that's going to be an inconvenient question, and you're going to have to fully document where those funds came from. It could be as simply innocuous as I got a bonus, right? Boom, your balance went up. But if it's money that's coming and you have to document it, and comes from somebody, a third party, it may have to be documented with a gift letter that says there's no obligations to repay this. This money was freely given, and both parties understand that it's not going to be repaid. It's not an obligation on your income. So, it could be a good thing, but you may have to document your way out of it.
And Keith, the most popular home loan in America is the 30-year fixed-rate conventional mortgage. The vast majority of homeowners in America have exactly that kind of loan. But is it right for everyone?
Well, different mortgage types and terms exist to meet different needs. All have advantages and drawbacks. A borrower looking for the lowest monthly payment might be best suited to take the longest term, like a 30-year fixed-rate mortgage. But of course, that will likely accrue the highest total interest cost over time. A shorter term mortgage will see lower total interest cost, but will carry a higher monthly payment, which can reduce borrowing power. An ARM can have a lower initial interest rate and monthly payments than a fixed rate loan for at least a time, but might expose a homeowner to a higher future monthly payment. There's no one-size-fits-all mortgage, but the good news is that loans can be refinanced essentially at will. So getting one that might better fit needs that have changed is certainly possible.
I see. And so, Keith, let's sum it up now. After a very comprehensive conversation, what's your best advice for anyone in 2026, 2031, 2036, or even beyond, if they plan to apply for a mortgage to buy a house?
Well, we can't know what the mortgage market 10 years from now will look like. After all, 20 years ago, it was a wide open, anyone can get financing bazaar with lots of unique and esoteric mortgage products. 10 years ago, it was a tightly underwritten, limited mortgage menu kind of place where lots of borrowers couldn't even meet the standards needed to get a mortgage. Right now, we're in kind of a traditional market, and this may be the one we'll be in for some time. It's a market where good credit, solid employment history, a manageable debt load, reasonable asset strength, and similar financial characteristics easily open the door to get a mortgage. I think that will still be the case in 2036, although the process by which a borrower will get a mortgage may have changed, as it has many times already.
Excellent. Well, Keith, I really want to thank you for walking us through the fundamentals of getting a mortgage in today's market or any market. Important information that I believe is going to help a lot of our listeners. And I want to thank you, Keith, for being on the show.
It's always my pleasure, Stephen.
Our pleasure, too. Keith Gumbinger, Vice President and Mortgage Expert at HSH.com, the nation's leading source for consumer mortgage and finance information. Next time on Real Estate This Week, the summer market. We'll have red-hot expert advice for buyers and sellers. We'll talk strategies, techniques, and tactics designed to help you succeed this summer. That's next on Real Estate This Week. And until then, I'm Stephen Gasque, and thank you for listening.
A brand new episode of Real Estate This Week with Stephen Gasque drops every weekend, everywhere. And you're invited to listen, subscribe, and follow us. Just look for Real Estate This Week with Stephen Gasque. The best real estate strategies out there, just for you.
Hey there, it's Wayfair here, where delivery and setup are as easy as a few taps on your phone. You're relaxing in an old hammock, scrolling Wayfair's app, when you spot it, a brand new patio set. Next thing you know, Wayfair delivers it right to your patio and sets it up. Oh, you need a new grill too? All right, Wayfair's got you covered. With Wayfair's Room of Choice delivery and fast expert setup on qualifying orders, life gets a little easier. Visit wayfair.com or the Wayfair app.
Wayfair, every style, every home.